Today we are covering American Depositary Receipts, REITs, and other equity securities for the Series 65 exam. First, let's break down American Depositary Receipts or ADRs. These are securities created by U.S. banks that represent ownership in a foreign company. They trade in U.S. dollars on U.S. exchanges, which makes foreign investing much simpler for American clients. The biggest trap the exam will set for you with ADRs is currency risk. A question might describe a scenario where a German company's stock, represented by an ADR, performs well in euros. However, if the US dollar strengthens against the euro, during that time, the investment returns could be diminished or even turn into a loss when converted back to dollars. The exam wants you to recognize that even though the ADR trades in dollars, the underlying economic performance is still subject to exchange rate fluctuations. Most ADRs also do not pass along voting rights to the investor. Next, let's focus on real estate investment trusts, or REITs. The single most critical piece of information for the exam is the 90% distribution rule. To qualify for special tax treatment and avoid being taxed at the corporate level, a REIT must distribute at least 90% of its net investment income to its shareholders. The exam will test this directly. For example, a question could state that a REIT distributed only 85% of its income. The consequence is that the REIT itself would have to pay corporate income tax on its earnings, which is a significant disadvantage. While there are other tests, like ensuring 75% of assets and 75% of income are tied to real estate, the 90% payout rule is the most frequently tested requirement. Finally, we have warrants and rights, which are often confused. The exam loves to test the distinction. Rights are short-term, typically lasting only 30 to 90 days. They are issued to existing shareholders to give them the right to buy newly issued shares at a discount, thus allowing them to maintain their proportionate ownership and prevent dilution. Warrants, on the other hand, are long-term securities, often lasting 5 years or more. They are usually issued as a sweetener attached to another security, like a bond, to make the offering more attractive. A key difference is their exercise price at issuance. Rights are issued with an exercise price below the current market price, giving them immediate intrinsic value. Warrants are issued with an exercise price above the current market price, meaning the stock has to appreciate for the warrant to become profitable to exercise. A simple way to remember the key features is this phrase: REITs pay 90 to stay tax-free and spry. Rights are short-term to keep your ownership high. Warrants are long-term, a sweetener you buy. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.